Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Pelosky of TPW with stocks coming off their 39th record high this year. We'll catch up with Poonam Goyal of Bloomberg Intelligence as Nike is attempting to stage a comeback, and Matt Hornback of Morgan Stanley calling for a string of 25 basis point rate cuts. We begin with our top story. Stocks coming off their 39th all-time high so far this year. Pelosky of TPW writing the Fed's move is likely to force even the die-hard recessionistas to give up on that point of view. There is no sign of recession anywhere. There is no major imbalance in any part of the US global economy. Jay joins us now for more. Jay, welcome to the program. I'm going to repeat that line again. There is no sign of a major imbalance in any part of the US global economy. Jay, China, discuss. What's happening in the world's second largest economy?
John, it's growing at almost 5%, which is more than twice as much as the number one economy in the world, the United States. And for all the doom and gloom in China, look, as an investor, the question is, what's in the price? And when you look at how China performs equity-wise, if you look at the valuation, my point is, one example is Alibaba, right? The big tech stock. We're believers in a two-tech stack thesis, China walling off its tech, U.S. walling off its tech. And Alibaba just announced that it now has the world's leading large language model, open source large language model. It's buying back stock at record levels. It trades at a fraction of the valuation of its U.S. peers. And so to us, it's all in the price. And just note that K-Web was up 4.5% yesterday. It broke back above its 200-day moving average. And it's emblematic of what we want to do right here. You talked earlier in the lead-up that I don't really care about a lot of what you and Lisa have been discussing. And, you know, that's not quite true, but it's true.
But mostly.
Hey, Jay, do you want to come back on this show again?
And I would just make, 2 points before we talk about the investment opportunities that we see at TPW Advisory. Point number one.
Jay, it's not a presentation. Just so let's step at a time. Let's just start with your views on China, and then Bramo wants to follow up.
Well, hold on a second, Jay. Actually, when it comes to China, I just have one word or one company to throw out at you, Mercedes-Benz. How do you understand that with all of this optimism that you just expressed?
Well, I expressed optimism about the tech stack and Alibaba. I didn't say anything about auto companies. Look, we're big, we have a TPW 20 model portfolio, which is focused on future innovation and climate. So we're very focused on the China's leadership in clean energy, renewables, and EVs. And the simple fact is that China is eating the lunch of pretty much everyone but Tesla in terms of EV production, activity, sales, innovation, et cetera. China is the world's innovator in clean energy, and the European auto companies are just watching their market share in China, which is a critical market for them, just simply disappear. And it's not even Mercedes-Benz, it's Volkswagen, which is out talking about laying off 30,000 employees in Germany for the first time in its 90-year history. There's a reason why Mario Draghi came out last week with a European competitiveness report and said that Europe needs to be more like what the U.S. has been doing. Public-private partnership, venture capital, innovation at scale. And the automakers are certainly emblematic of that concern for Europe.
So, Jay, for people seduced by your view of the world, I know it's a multi-year view, and a way of expressing it is the commodity market. Iron ore off the highs of the year, base metals, copper off the highs for the year. What kind of moves are you looking for in commodities, Jay?
Yeah, John, you no surprise, hit the nail on the head. That's where we want to focus right now. I wanted to mention the two strengths. One is in the global economy, absorbing one of the most aggressive rate hike cycles in modern history without a recession. That's something we need to pay attention to. And likewise, in the equity markets, particularly in the U.S., new all-time highs. You noted it, 39 all-time highs this year. While tech, the leadership sector in the lead dog, NVIDIA, is down 20% from its high. We have to respect the fact that trends are powerful, and they are moving in the right direction, both in the global economy and in the risk asset markets. So what do we want to do here? How do we want to invest? We want to sell the things that have done well on the idea that there's going to be a recession, because there's not. And so we don't like fixed income. Lisa talked about, 3.7% on the 10-year. Unattractive if the neutral rate is 3%. We want to focus on the context of a long cycle, sustainable, soft landing equals sustainable equals our global macro blue sky outlook, which we've talked about, 2023 to 2027. We're now focusing on that, not the next quarter, not the next 6 months, the next several years. We believe we're in a setup. And their commodities look really, really attractive. B of A pointed out allocations to commodities are at a 7-year low. Hedge funds are their most short commodities they've been in a decade. So there's a real opportunity there. There's a real opportunity in buying the laggards, things like small cap, things like the non-U.S. markets, which are still 10 to 15% off their highs. China is 40% off its high. I'm not going to say it's going to go to a new high, but we want to be buying the laggards if this is going to be a long cycle, a sustainable growth path, a Fed cutting through 2026. That's what investors need to be paying attention to. We wrote a piece several weeks ago, zoom out, not in.
Jay, all of this leads me to question what your view is on utilities, one of the most loved areas out there. And I know that sounds like a hyper-specific point with a lot of the calls that you're making, but it seems like it's a 1-2 punch. They've done really well just as a performance, but also they would benefit as a bond proxy. Both of those reasons, how much do you think that very loved trade is not going to do so well?
Well, utilities, in our view, have done well, in part because they're viewed as a recession hedge, and in part because they are viewed as being in one of the hot sectors, which is, power generation for the data center and data centers in the AI revolution, which we're big believers in. We own an ETF called GRID, G-R-I-D, as our way to play this, and GRID just broke out and is at a new all-time high. So that's the way we're playing it. We don't really like the utilities at this point because they've been pretty well exposed, and we don't think rates are going lower, and we don't think there's going to be a recession. Rates on the long end, not on the short end, obviously. So what we like is industrials, right? I think one of the surprises in the next couple of months is that the ISM for manufacturing is going to break back up above 50. And you look at what's leading. I made the point about markets at all-time highs while tech is still well off its all-time high. Industrials, financials, real estate. There are multiple sectors that are breaking out. And one of the things we like, in addition to industrials, we just added a position, is in consumer discretionary. You talked about FedEx. Amazon is very attractive. Tesla's very interesting here. They make up 40% of XLY, the consumer discretionary ETF. And that's an example of where we're moving to as opposed to where we've been.
This was Jay Pelosky's TED Talk, brought to you by TPW. Jay, it's good to see you. As always, you're a good friend. You're welcome back anytime. Appreciate it. Rates. The rate cut euphoria is fading as markets begin to wonder about underlying economic weakness. Veronica Clark of Citi saying Powell paid a 50 basis point rate cut with an emphasis on the low level of the unemployment rate and confidence on the path ahead. We disagree with the view that recession risk is not elevated. A continued rise in unemployment will likely have them cutting faster than their dots imply. Veronica joins us now for more. Veronica, good morning.
Good morning.
This is not going to be a therapy session. Don't worry, I'm not going to make it that. I won't insult you with that. But I do want to talk about how you and the team thought thought about this on Wednesday. And for our audience who might not be familiar with the work that you and Andrew do, you were out front on the 50 basis point call. You said it was data dependent. The data came out. The data wasn't bad, and you changed the call again back to 25. What were you thinking when that dropped on Wednesday?
Yeah, it's been a crazy couple weeks. We did change our base case for Wednesday back to a 25 basis point cut after we saw CPI a week ago, stronger details, stronger shelter inflation again. We were thinking maybe that was the easier compromise for the hawks who are still concerned about inflation. But I think on Wednesday, of course, when we got the 50 basis point cut, it is definitely justifiable based on the weakening of the labor market. And we did learn that Fed officials are kind of dismissive of stronger CPI. Chair Powell was very dismissive of that stronger shelter reading, just expecting that will slow. And it is really the labor market that matters.
It's an important lesson for us all. So talk to us about what you'll be looking for between now and November 7th. What will guide the ultimate call for you and the team?
Right. Well, we'll have 2 monthly employment reports. So that's, of course, payrolls and the unemployment rate. Those are really the most important, of course. Watching all the labor market data, weekly initial jobless claims. But we do think this is a weakening labor market. We've seen that more pronounced in the last 3 or 4 months. Of course, that's what got us to the 50 basis point cut this week. I think that trend will continue. I think we'll see more weakness in those 2 employment reports, and it's another 50 in November.
This, to me, is a really important point, that you think that it's going to be just as aggressive going forward because of the weakness that we see. There's been a real question around just how well this transmission mechanism of the Fed policy can actually help support the economy. Do you think that, given the reaction to this latest Fed meeting, that will help stave off some of the weakness that you're expecting to see?
I don't know. I mean, a couple months ago, the narrative was that the economy is so strong and the Fed doesn't have to cut because of that. And now we're saying the economy is strong because the Fed is cutting. But what's changed in that period is the labor market data have weakened, and it just seems like that trend will continue. These things are really hard to prevent. Once you do get rates substantially lower back to neutral, I think that, or maybe even a bit below neutral, I think that can re-stimulate things. But we're still a long ways from that right now.
Paul Donovan of UBS earlier said they don't know anything that you don't know. So don't stop thinking that. It's not like there's some kind of sort of feeling underneath this fear of a recession on the Fed committee. How much do you think that that's true?
I think there may be a bit, or at least maybe Powell is a bit more worried than he's letting on. I mean, we are all looking at the same data, and he is looking at falling hiring rates like we are. Maybe some early signs that there are actually a pickup in layoffs. The transitions for the last couple months of people moving from employed to unemployed have actually increased, the highest since 2016. And I think he's worried that once you do see large, clear signs of layoffs, that's when it's too late. You want to get ahead of that.
I'm going to take this conversation to the edge of ridiculous, but there were times, I'm going to read the body language now, forgive me, there were times in that news conference where it felt a little bit performative. It felt a little bit forced, the confidence, things are great, ignore the 50, the size of it, this is a recalibration, things are good.
Okay.
Did you not feel the same thing?
Yeah, no, I felt the exact same thing,
right?
Because there was, in previous times, in previous news conferences, he was less practiced. He fumbled more. He didn't seem to have the same kind of, polish in the same kind of way. This was someone who was acting as a lawyer, which was the reason why that Kit Jukes comment was so interesting earlier this week. This was someone who was making a case more than, say, delivering a message that was his true message.
It felt like a performance. Let's get back to race. Okay, we can park that. Just wanted to get it out there. It's out there now. Okay, let's get back to race. Lisa and I were talking about this earlier, about how you view the rate cut path implied by the dot plot from here, whether that's a ceiling or a floor for interest rates. And Matt Hornback of Morgan Stanley framed it better than I could. He said, if they're wrong, how are they wrong? And I think what you're ultimately saying is we should consider that a ceiling for rates because they're going to get back to neutral quicker than they think. Right,
yeah, absolutely. The last couple, summary of economic projections has almost felt like a marking to market. This is where the market already is in terms of rate cuts. It's also a marking to market in terms of the unemployment rate. Obviously, they had to raise that this week. And we're always, of course, first and foremost, basing our Fed view on where we think the data are headed. And we don't think the data are going to evolve in a way that's consistent with that SEP, and they're going to have to do more.
How much do you think that the reaction function of the Fed is biased toward bigger cuts? I mean, how much do you think that that's what this signaled rather than they wanted to start big and then move gradually?
I think it's a pretty low bar to get some more larger cuts. We are very far from neutral. Powell has said a number of times that there's ample room to be cutting if something goes wrong. And you do want to quickly get back to neutral in a weakening labor market, not get back to neutral a year from now.
So median dots did this. for this year and next year. The long dot did this. Came up just a touch. How are you thinking about that long dot?
Yeah, it is interesting. I do think there is that sense in which maybe neutral rates, at least nominally, are a bit higher. We wouldn't diskagree with that.
What's your number?
Yeah, 3.5%. I think that's probably fair. We essentially have them getting back to there, like a 3% kind of terminal rate, and I think that's fair. I would worry that even if that is a neutral rate, maybe they have to get a bit below neutral even.
Paul Donovan of UBS came out and said, what did the higher rates achieve? Not a whole lot. What do lower rates achieve? Even if you go back to below neutral, what are we stimulating?
Yeah.
What part of the economy?
I mean, I think high rates did achieve, bringing inflation down. I think, mission accomplished in a sense in that way. Yeah, we saw housing slowing. We should see shelter inflation slowing at some point because of that. Demand, of course, is much weaker. But of course, that also means that there has been this increase in unemployment. You would expect lower rates to eventually, re-stimulate sectors like manufacturing or housing. But it will probably take a couple quarters to see that, I think.
What did Paul call rents? The fantasy of
OER.
Yeah, of OER.
Yeah, I love that. I love the small rants, the sort of small frustrations.
Everyone who didn't go with the 50 this week has got something to, get annoyed about.
It's great.
Veronica, can we finish on housing and the price of shelter? We've had so many different views on this, that ultimately if you unlock all that inventory, that supply, prices actually might go down as interest rates get cut. How are you thinking about the forces, this channel for interest rates to work in the housing market?
Yeah, I think that is true eventually, but we're still a long way before we maybe get some kind of supply response, I think. We have seen rates coming down. Of course, mortgage rates have come down. We're watching the weekly data on mortgage applications filed for home purchases. That really hasn't picked up at all. I think the issue is that, yes, lower rates will stimulate demand for housing, but now we also have the issue of a weakening labor market and weakening consumer health offsetting that. And that might be the more overwhelming driver in the next couple quarters.
So final question, next move, size, 25, 50?
50.
50, all right. Don't change it. Veronica Clark of Citi, it's good to see you. Joining us now, I'm pleased to say, Tom Becker of Blackrock. Tom, good morning.
Morning.
It's good to see you. Here. I feel like this narrative's gone back and forth for the best part of 2 years. Hard landing, soft, no landing, hard landing, soft landing. What is it now?
So we've got a bit of a different view than kind of Veronica's view there. So we're still in the no landing camp. So this economy to us has been a 5 to 6% nominal economy pretty consistently for 2 years now. And so some quarters it looks like inflation's a little too hot, then another quarter growth's a little bit hotter, but you've been trading off with this economy kind of operating in this notably higher nominal kind of range than it was pre-pandemic. We think that's set to continue. The economy is much less interest rate sensitive than it was pre-pandemic. People termed out their mortgages. A lot of the spending that we're seeing in industrials is coming from kind of a guns and butter 2.0, what we're calling kind of, this fiscal policy, reindustrialization, onshoring, nearshoring. That stuff is driving kind of interest rate insensitive spending back into the economy. And we think the consumer is actually really well set up here. They've got household balance sheets in really good shape in terms of wealth. They're earning much stronger wage growth than they were kind of pre-pandemic. This is like 1990s type wage growth. And so that sets them up really well with interest income coming back into their flow. And we think inflation's settling now in a 2.5 to 3% range. Fed seems okay with that here, but that's kind of a no landing outlook from our perspective.
Can I pick out one point, the interest rate sensitivity? Is that symmetrical or asymmetrical? If we weren't sensitive on the way up, are we sensitive on the way down?
So I think if you just look at when people how much time people had to term out debt, both corporate treasurers, households, you had all of 2020, all of 2021. That debt is still pretty fixed rate for a number of years here. So we don't think there's a lot of sensitivity for a lot of this spending. And that's kind of how the economy's behaved the last couple years. So we think that's kind of set to continue. There are pockets of weakness, and I think a 50-point basis cut definitely is going to bolster those parts of the economy that have been a little bit more. But overall, the economy is performing like it doesn't really get impacted by kind of these swings in rates we've had the last couple of years.
I want to put that on a reel. no landing, hard landing, soft landing, soft landing, hard landing, hard landing. I mean, honestly, that was absolutely
That's a
brilliant.
summary of the last 18 months.
I mean, it was really absolutely perfect. It kind of brought back, flashes. This idea of the no landing is a U.S.-specific story.
Yeah.
I don't think that Germany is feeling no landing right now.
Right.
How do you sort of play the idea that the U.S. has been the dominant overweight for so long, continues to look like it's probably the strongest economy on a relative basis, yet is still at pretty high valuations?
Yeah, sure. So I think you picked on the poster child of kind of the weak man of Europe. If we look broadly across Europe, the periphery is booming. Periphery hasn't looked this good in decades. So look at Italy, look at Spain. They're doing great. Canada lagging a little bit more. Canada's more interest rate sensitive. Germany's more Russia and China sensitive. So you definitely have economies that are a little bit weaker, but their nominal growth is higher too. Their wage growth is higher too. And so you've got developed markets with all-time tight labor markets. We think the U.S. labor market's much tighter than kind of, maybe this recent rise in unemployment, begets. But you've got kind of Japan kind of firing on all cylinders, strong CPI data overnight. In the totality, we think Europe looks pretty robust, and the valuations there and the positioning are light. And so we're a macro tactical team. We look for kind of opportunities where the narrative is negative, where people are focusing on Germany, but maybe missing that the periphery and the rest of Europe look better. And so over the summer and then more recently, we've been stepping into kind of tactical longs outside the U.S. So agree with you completely. So like the U.S. does look well held, overbought. Every time people kind of step out and go into foreign markets, there's a French election, or there's like the kind of the bungled press conference in the BOJ, and they're like, let me just go back to the U.S. We think that creates opportunity and creates kind of pockets of good pricing for us to kind of step into these strong global companies and strong indices.
No one's listening. Is it just that you look to go to places that you actually want to go to, that sort of are fun to go to? I feel like that's part of it. I've been to Japan 10 times. I've been to Greece to check out their beaches and then invested, I mean, is that basically what people are doing?
I think Americans have been spending in those places. So we just did a podcast on Taylor Swift era's effect in Europe.
Go on, tell us about it.
You've got kind of countries like Sweden where they had all-time high month-on-month services inflation just because she did 3 shows in Stockholm. So, and that's a lot of Americans flying over because they're like, oh, it's cheaper than going to the Meadowlands. And so I think that there is this. People are spending differently. People are not behaving like they think their jobs are in danger. And I think the income, this last labor market report, you can say, oh, look, the trend the creation of jobs is a little bit lower. Hours are up. Wages are up. And so that's money in people's pockets that they're spending. And I think in these foreign markets, nominal incomes are higher, so unemployment rates are low and people are making more than they were in the last decade. We think they're kind of going to start spending it more, and savings rates can come down in Europe, and they can kind of unlock a consumer that they haven't had for years.
I heard a great line the other day, and it was borderline insulting. It was, don't invest in countries with green in the flag. And Italy was part of that story for a long time. In Europe, the way people view Europe was that Germany's strong and Italy's weak, and it's the complete opposite now on the continent. When you look to take that exposure, you alluded to it just a touch. We used to talk about it through the currency. Yeah. But now the currency's held back by developments in China and what's happening in Germany. How do you take that exposure if you just want to get exposure to Italy specifically? Yeah, so you can buy the index. That's what we do. We buy the local index, the FTSE MIB, get exposure to kind of the broad set of Italian companies. You've got banks in there, they're doing well with spreads coming in, but you've got a lot of kind of services-based companies that aren't exposed to kind of Russian gas or to Chinese exports. So that's the way we do it there. Since we're top-down macro investors, we focus on that country dimension. So we're going in the local, we separate the currency bet from the local equity market bet. And so we can be underweight dollars, but we can also be kind of long a foreign kind of local equity market. Got a question on the Bloomberg terminal from a Bloomberg subscriber. I think a lot of people might have a similar question. You keep referring to higher nominal GDP. Of course, higher prices have been a big factor in that. If you think things are going to hold up at these kind of levels, what's your outlook for inflation? Lisa's been talking about steeper curves and gold breaking out as well. What's your outlook for inflation?
We think we've settled in this new higher range. So
3s.
3 is the new 2. I think 2.5 to 3 here because we've had kind of a bit of a weakening after a strong Q1. But we think services inflation is going to really underpin higher inflation rates. You've got consumers consuming in a services-based economy, but you've also got a lot of structural changes. Insurance markets are kind of a multi-year repricing to kind of higher nominal valuations. Insurance rates in California going up 25, 30, 40% for households, and that feeds through into the economy. Restaurants have to raise their prices to deal with that. And so I think there are these slower moving effects that are underappreciated as people focus month on month, or, was it jet fuel this month? Was it OER this? It's like, but if you look at that slower moving kind of dynamic of sticky services inflation, it's not just the US. It's happening across all these developed markets, tight labor markets, people spending more of their wage growth, and that's feeding through to kind of sticky services inflation. So China can bring down goods inflation for a few quarters like it has, and then you're like, false dawn, we've landed. Yep. But I think then it bounces back up if you get a surprise stimulus program. Draghi, I think, a call to arms for fiscal in Europe. They always react too slow, but I think in Europe, you should think that going forward, there might be some fiscal. There might be another kind of upward surprise there.
This was one of the sharpest conversations we've had this week. Appreciate your perspective. Come back soon.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.